Hey CMA buddies, let's today continue with the concept of cost of capital. Today we will be starting with cost of retained earnings, right? So what exactly is retained earning? Retained earning is nothing but whenever a firm is basically earning some profit. Now this profit can be utilized for further development or the growth of the organization, right? So this profit is basically divided into two parts, right? One is kept with the organization itself, and that's what we call as retained earnings, right? For the further growth or development or reinvestment in the business. The second part of this profit is basically distributed as dividend to the shareholders of the company, right? So that's how the retained earnings things comes into the picture. Okay. Now let's understand retained earnings and how basically you calculate the cost of retained earnings. Now, like other sources of fund, retained earnings also involves cost, right? But what kind of cost does it involve? It is the opportunity cost of dividends foregone by the shareholders, right? As I said, this profit is basically divided into two parts, that is retained earnings and dividend. So, for example, if a company has a profit of say 10 rupees, right? 6 rupees is given as a dividend, but remaining 4 rupees is the retained earnings, right? Now, had this 4 rupees been given as a dividend, in that case, what shareholders would have done is they would have reinvested this money and earned some income on that. Yes or no? But what company is doing is for the further growth of the company, it is retaining this earning. So basically, this is opportunity cost loss for who? For the shareholders. I hope you understand what is opportunity cost. If not here, then it would have been put in somewhere else and more or a return would have been earned on it. But that's not being done because the company is retaining this amount and not distributing it as a dividend. Hence, what dividend holders or what the shareholders are foregoing or what they are leaving for the sake of the growth of the company is this amount, which is called as retained earnings. So basically, this is an opportunity cost. So like other sources of fund, retained earnings also involves cost. It is the opportunity cost of dividends foregone by the shareholders, right? So basically, what is the cost of retained earnings? This is basically the opportunity cost of dividends that is foregone by the shareholders, right? Okay, now if the cash is reinvested, what is this cash all about? This cash, that is the retained earnings amount, if that would have been cash and if it would have been reinvested, the opportunity cost is expected rate of return that shareholders could have obtained by investing in financial assets, right? That's what I intended to. So that means if this 4 rupees would have been given to the shareholders, if they would have reinvested it somewhere else, they would have got some interest on that or some kind of income out of that. So that income is being foregone by those shareholders. So that becomes the cost of the retained earnings, right? Simple logic, nothing complicated, right? Okay. Now the cost of retained earnings is often used interchangeably with the cost of equity. In the last video, we have already seen how to compute the cost of equity. If you haven't checked that video, please do that. In that, clearly I have explained how do you compute the cost of equity. So the concept of cost of retained earnings and cost of equity is more or less the same. There's no difference in that because as the cost of retained earnings is nothing but the expected rate of return of shareholders from the investment in the shares of the company. Yes or no? Basically, cost of retained earnings is very similar that the shareholders would get as a return from the investment in the shares of the company. So the computation of cost of retained earnings and cost of equity share is more or less the same. There's a minor difference that you need to understand. Normally, cost of equity remains higher than the cost of retained earnings. Why? Because due to the issue of shares at a price lower than the current market price and the flotation cost. We all know whenever we issue an equity share, in that case there's a certain flotation cost involved. What is a flotation cost? I've already discussed that earlier, but if there is any commission, any brokerage charges that is there during the issue of the shares, in that case that amount is called as a flotation cost. And always remember, whatever is the current market price of that of a particular share is, the shares will be usually issued at a price lower than that, so that there's a subscription element in that. If the prices are very high, if they're equal or the prices are very overvalued, in that case the shareholders won't subscribe for the shares and at the same time they may incur some loss. So basically to ensure that there is a good subscription of the shares are basically issued at a lower price than the current market price, right? So that is the main difference between retained earnings, the cost of retained earnings and the cost of equity shares. So please understand, the cost of equity basically remains higher, that is cost of equity, that is KE, remains higher as compared to KR. We represent retained earnings through KR, right? Okay. Now, what are the various formulas used for the calculation of cost of retained earnings? They are very much same or similar to that of the equity shares. Now, for example, dividend price method. We all know what is dividend price method. Dividend price method in case of case of equity was dividend divided by the current market price. Similarly, is the case with the cost of retained earnings also. So it is the same, it is D by P. Similarly, if it is an earning price method, the formula is EPS by P. And in the case of growth method or the growth model, it is D1 divided by P0. That is the dividend for the first year divided by the current market price plus the growth element that is there, right? So these are the various terms that are used. First line you can leave. The second one says for the calculation of KR, P is what? P is current market price. We already know that. However, sometimes issue price may also be used, right? In case the current market price is not given, if the current market price of the share is not given, in that case you may even use the issue price also, right? Okay, the concept of flotation cost is not used for the calculation of cost of retained earnings. Yes, that is very obvious, because the cost of retained earnings doesn't contain any kind of flotation cost or any extra or additional charges. And so whenever we calculate the KR, in that case the flotation cost is not taken into consideration, right? So please remember, flotation cost is not considered during computation of cost of retained earnings, fine. Okay, so one important point, please remember, overall it can be implied that KE, that is the cost of equity, should be used as KR, but KR, that is the retained earnings, would be lower than KE. Why? Because due to differences in flotation cost and due to payment of dividend payment tax. So there is not even a tax component that is involved in it. Hence, the difference between KE and KR is that usually KR doesn't have any kind of flotation cost, and also there is no need for the shareholders to pay any dividend payment tax. Fine. Okay. It assumes that the shareholders would have invested the dividend on receipt. Yes or no? That's very obvious. If the retained earnings would have not been held by the company, that would have been given to the shareholders, then in that case those shareholders would have reinvested that amount of dividend. So the cost of equity is to be adjusted with what? With the marginal tax rate. We spoke about the tax rate here. So whatever KE figure is there, from that we have to reduce the marginal tax and the applicable commissions and brokerage, and hence you will get the value of KR. So technically speaking, you would see that KR, the formula for KR is what? It is KE, that is the cost of equity capital, into 1 minus the tax rate that you have and 1 minus commission or brokerage that you have. So this is the formula for KR. In case the data of tax, in case the question gives you cost of equity, tax rate as well as the commission. Otherwise, if simply the question gives you the data similar to what we used to compute for cost of equity, in that case you can compute the KR in the same way as we used to compute for equity, right? Okay, let's shoot to the direct to the questions directly. Let's start with the question number 23 or the illustration 23 of your book. Okay, the question says a firm's KE, that is cost of equity capital, is 10%. So you are given KE as how much? 10%. It says the average tax rate of shareholders is 30%. So the T is given to you, that is tax rate given to you as 30%, and it is expected that 2% is brokerage cost that shareholder will have to pay by investing their dividends in alternative securities. So that means even cost is given to you. If in case the shareholders basically invest in some other alternative investment, what is the rate of brokerage? It is basically 2%. What is the cost of retained earnings? So technically the question is asking you to calculate KR, right? Okay, so what is the formula for KR? KR is simply KE into 1 minus tax rate into 1 minus commission, right? As we did it, as we saw in this formula here, fine. So simply putting in the value, you know KE. What is the value of KE? KE is 0.10, that is 10%, 1 minus 30%, that is 0.30, into 1 minus E, that is 1 minus 0.02. Right, that is 2%. So if you just simply calculate this, what you get is 0.1 into 0.70 into 0.98. So simply multiplying this, what you get is 6.86%. Simply calculate this value and multiply this by 100 and you get in terms of percentage. Hence that is your answer, right? Okay, let's move on to the next question. The next question says AKS Limited retains 10 lakh out of its current earnings. So basically they are giving you the retained earnings. What is the retained earnings that is given? That is retained earnings is basically given you as 10 lakhs. Fine. Okay, it says the expected rate of return to shareholders if they had invested the fund elsewhere is 10%. Fine. So the return rate that is given to you is how much? The return rate basically is given as 10%. And it says the brokerage is 2%. So basically you are given the brokerage. Now brokerage is what? It is basically 2%. And the shareholders comes in the 30% bracket. And the tax rate is given as 30%. Calculate the cost of retained earnings. Fine. Okay, so how do you calculate the cost of retained earnings? Now please understand, what is the return rate? The return rate is basically 10%. So the capital that is given to you is basically 10 lakh rupees. Fine. So what is basically the earnings? The earnings, but this is what earnings? This is earnings before interest and tax, EBIT. Fine. Because there is no tax deducted yet. And if there would have been any component of interest, even that needs to be subtracted, right? So if you simply look at the EBIT, that is earnings before interest and tax, it is what? It is basically 10 lakhs. That is the retained earnings. That is the current earnings that you have into what is the rate of return on the earnings? It is basically 10%. So what is this value? This value comes as 1 lakh. Fine. Okay. Now if you just simply subtract tax from this, what is the tax rate? Tax rate is basically 30%, right? 30% of what? Obviously you have to deduct tax from the EBIT, that is 1 lakh. So if you compute 1 lakh from 30%, the value that you get is 30,000 rupees. Hence the value now that you get is earnings after tax. How much is it? This is basically 70,000. Yes or no? Okay, now please remember there is a brokerage of 2% that you need to subtract. Fine. Okay, please remember the brokerage cost is always calculated on the actual amount that is supposed to be invested. That is 10 lakhs and not from the earnings amount. That is the interest amount. I hope you get that. The brokerage that you levy, that is this 2%. This 2% is basically on the 10 lakhs. That is the actual capital. Fine. Brokerage is always on the actual capital and not on the interest amount. Fine. So hence what you're supposed to do is you're supposed to subtract the brokerage component. How much is the brokerage? Brokerage is basically 2%. Please remember of 10 lakhs. Please don't get confused. Please don't take it as 1 lakh because 1 lakh is basically the earnings from the total investment. But the brokerage is always levied on the total capital. So if your total capital is 10 lakhs, that is AKS retains 10 lakhs of its current earnings. In that case, this brokerage is basically calculated on this 10 lakhs, which is 2%. Hence, if you just simply subtract, the value is 20,000. So now the net earnings that you get after your deduction of brokerage as well as the tax, the value now stands at 50,000. Fine. Okay. So what we need to calculate? We need to just calculate the cost of retained earnings. Cost of retained earnings is simply nothing but 50,000. That is the net earnings that you get divided by the total capital, that is 10 lakhs. And since you need it in terms of percentage, multiply with 100 and the value that you get is 5%, right? So hence your answer should be 5%. I guess now you understand. Please don't confuse the answers between question number 23 and 24 because 23 directly states what is the KE. The value of K is given. Please note that in your book the answer is incorrect because they have taken this 30% as 50%. You can calculate either ways, but I have calculated as per the question. So there may be a slight variation with respect to answer of question number 23. But as far as 24 question goes, it has given you the total capital, that is 10 lakhs out of its current earnings, because that is something to be distributed as what? It is basically retained. sort of this retention, you get certain amount of interest on that. What is that interest component? That is only 10%. So 10 lakhs ka 10% is basically 1 lakh. On that you are supposed to deduct what? You are supposed to deduct the tax that is to be paid by the shareholders. So you subtract 30% on it, you get 70,000, and then you subtract the brokerage. Now please remember, the brokerage amount is what? Brokerage amount is 2%. 2% of what? The total capital, that is 10 lakhs and not 1 lakh. So simply subtracting 2% of 10 lakhs, you get 20,000, and the net earnings is 50,000. Hence your KR, or the cost of retained earnings, should be 50,000 divided by total capital, that is 10 lakhs, which is equal to 5%, right? Okay. Beyond this, let's look at some questions which may be asked in your exams also, which I feel are relevant as far as the cost of retained earnings are concerned. Small questions, we'll try to wrap it up as soon as possible, right? Okay, let's look at the question. Question simply says, face value of equity share of company is rupees 10, while current market price is 200 per share. So basically you are given current market price. We denote current market price by P, which is how much? Which is rupees 200, right? Okay. It says company is going to start a new project and is planning to finance it partially by new issue and partially by retained earnings. So company is basically going to make some new issues, and partially it is going to do through retained earnings. You are required to calculate cost of equity share as well as cost of retained earnings. So you got to compute both. You got to compute even KE, and you are supposed to compute even KR. So we'll try and compute both. Okay, and it says, if issue price will be rupees 190 per share and flotation cost will be rupees 5 per share, dividend at the end of the first year is expected to be rupees 10 and growth rate will be 5%. Now you can see that the dividend is given and a growth rate is also given. Fine. So if both of them is given, what is the formula that you are supposed to use? You're basically supposed to use the growth model formula, right? Very obvious, because growth rate is given, so obviously we'll be using the formula of growth model. Okay. Now please remember, the price that is given to you of 200, this price basically will be used in the case of KR. Yes or no? Because it says, while the current market price is 200. So if you remember that, whenever we compute the KR through growth model, the formula that we use will have current market price. I'll just quickly revise that for you. If you just look at here it simply says, you look at this growth model, D1 divided by P0 by D by G. Here P says current market price. So whenever you're computing growth model for KR, that is cost of retained earnings, you are supposed to take the current market price. No confusion in this. Okay. What is the formula for this? The formula is simply D1 divided by P0 plus the growth rate, right? Okay. What is the dividend? Dividend here is given that dividend at the end of the first year is expected to be rupees 10. So dividend at the end of first year, that means D1 is given as how much? This is given as 10 divided by what? Your current market price, that is rupees 200, and you are given the growth rate. How much is the growth rate? Growth rate is 5%. So simply computing this, you get how much? You get 10 divided by 200. So this should be 0.05 plus 5% is what? This is also 0.05. So simply you just look at this, it is 0.10, simply multiply it by 100, hence the value of KR should be 10%, right? Okay, now moving on to KE, because question asks you both, calculate the cost of equity share as well as the cost of retained earnings. In case of KE, what you are supposed to do is, formula remains the same, right? It is basically D1 divided by P0. But please remember, there's a flotation cost involved in this, because question says there's a flotation cost which will be rupees 5 per share. So you minus the flotation cost here plus the growth as it is, that is given. Okay, what is the dividend that is given? Dividend is basically 10, undoubtedly. Okay, please remember, in this case you have to take issue price into consideration, because we are computing KE and not KR. So whenever issue price and the market price is given, the weightage is always given to the issue price. Fine. In that case, your issue price is how much? This is 190 minus what is the rate of flotation cost, or the amount of flotation cost, that is rupees 5 plus 5%. Okay, so that is the growth rate. So simply computing this, you get 10 divided by 185 plus 5%, which should be equal to 0.054 plus 0.05. Hence the value that you get is 0.104 or you can say 10.4%. If you just simply multiply this by 100, get value as 10.4%. So the cost of equity capital is 10.4%, whereas the cost of retained earning is 10%, right? Okay, let's move on to the next question. ABC company provides the following details. Fine. It says D0 is 4.19. Please concentrate. It says D0. So basically it is giving you D0, but whenever we calculate something, we need D1. Fine. The P0 is given as rupees 50 and the growth is 5%, right? Never calculate the cost of retained earnings or the equity capital with D0, because we always need the dividend at the end of the first year. So technically we should calculate D1 first. So how do you calculate D1? D1 is basically D0 plus the growth rate. Yes or no? Okay, so what is D0? It is 4.19 plus what is the growth rate? Growth rate is 5%. Fine. Why we are adding this growth rate to D0? Just this I have already discussed in the last video, but just for your clarification, because there is a rule, there are certain assumptions in growth model. First rule says that your current market price is based on future expected dividend. Hence, you assume it to be D1 and not D0, just for the clarification purpose, right? So simply 4.19 plus 0.05. So the value will come out to be 4.40 approximately. Fine. Okay. Now if you just calculate the value of KE, or the KR rather, sorry. KR should be what? D1 divided by P0 plus G. Now you know the D1 is 4.40 divided by P0, that is 50 plus 0.05. So simply computing this, you get as 0.088 plus 0.05, which is equal to 0.138. Need the value in percentage, hence you multiply this by 100. The value that you get is 13.8%. I guess you understand this question. Please make sure that whenever you are computing KR or KE, you should always use D1 in case of a growth model and not the D0, right? Okay, let's come to the last question with respect to cost of retained earnings. Question is, ABC company provides the following details. What are the details? It gives you RF, that is risk-free rate of 7%, beta of 1.2, and RM minus RF, that is 6%. Calculate the cost of retained earnings based on CAPM method. Even if he would have not have mentioned CAPM, it's but obvious that we would be using only this technique to calculate the cost of retained earnings, right? Because the data given to us completely supports CAPM method only. So what is the formula? It is RF plus beta into RM minus RF. How I arrive this formula is more clearly explained in the cost of equity, so please refer to that video. What is RF? RF is basically 0.07, that is 7%. What is beta? This is 1.20, and RM minus RF is directly given as 0.06, that is 6%, right? So simply computing 0.07 plus 1.2 into 0.06 is basically, I guess I'll take the value completely. If I just multiply this and add this, I get 0.142, or the value I can say is basically 14.2%, right? That's the answer for this question. So with this we finish cost of retained earnings. In the next chapter or in the next video we would be looking at cost of or rather we would be looking at something called as WACC, that is weighted average cost of capital. Fine. And with that we will be finishing cost of equity or the cost of capital chapter on a whole, right? If you like this video, please press the like button and do subscribe to our channel. Thank you for watching and enjoy your learning.